You're watching vTalkInsight, Market Drivers Daily for August 11th, 2026. With AI financing now measured in hundreds of billions and Brent crude hovering just below $90, the key question is how far growth and risk assets can stretch as yields grind higher. Let's start with the AI capital cycle, where the scale and structure of funding are shifting fast. The AI story has moved into a financing super phase, where capital structure is almost as important as technology. Compared with earlier in the week, when we focused on capex ramping, today the spotlight is on how those trillions are actually being funded and what that could mean for credit, equities, and inflation. NVIDIA is working with a group of major financial firms to mobilize around $500 billion for AI infrastructure, effectively turning compute capacity into a financeable asset. At the same time, Intel has raised $20 billion in equity at a meaningful discount, with demand reportedly many times oversubscribed, underscoring strong appetite for AI hardware exposure despite higher rates. These deals illustrate a shift where GPU clusters and data center assets are being securitized and used as collateral in structures that resemble aircraft leasing or receivables finance. Investment-grade spreads for many AI issuers remain tight, suggesting credit markets are comfortable for now, yet NVIDIA's credit default swaps have ticked above some hyperscalers, hinting at rising concern over the risks embedded in these new instruments. Much of the AI build-out is still funded with debt, from tech bond issuance to asset-backed structures, and that demand for capital is one reason long-dated Treasury yields are pressing toward recent highs. A 10-year yield approaching 5%, especially if real yields rise, could eventually force more discipline on marginal AI projects and slow the most aggressive capex plans. Set against those risks, the operating data remain powerful. Companies cite efficiency gains of 50 to 90% in logistics and insurance workflows, and private equity-backed businesses report widespread AI adoption with clear payback, while earnings from AI server and infrastructure providers show triple-digit revenue growth and upgraded guidance. Still, there are early casualties and valuation questions. Some software and internet names are cutting guidance as AI automates parts of their revenue base, and leading-edge AI and chip names are trading at 30 to 40 times sales, a level that leaves little room for execution error. For now, the main watch points are funding costs, the durability of GPU pricing and demand, political pushback against new data centers, and evidence from upcoming earnings and IPOs on whether AI monetization is keeping pace with this financing wave. Turning to energy, the hope for relief on Middle East supply risks has not materialized in a durable way. Brent crude is around $88, with repeated spikes toward $90 as negotiations over the Strait of Hormuz stall, and both the United States and Iran harden their positions. Shipping through Hormuz and nearby waterways remains fragile, with reports of vessel strikes, naval enforcement, and even so-called dark transit transfers trying to bypass restrictions. Executives increasingly assume disruptions could persist into next year, and that keeps a risk premium embedded in oil, refined products, and related freight markets. Europe sits at the sharp end of this shock. Diesel prices are up around 10% year-to-date. Benchmark European gas has more than doubled to the 50 to 60 euro per megawatt-hour range, and low German storage after a cold winter leaves limited buffer heading into the next heating season. The macro transmission is clear. Higher energy is feeding renewed inflation concern, pushing U.S. 10 and 30-year yields back toward multi-month highs and keeping pressure on central banks like the ECB and Bank of England to lean hawkish. Elevated oil also tends to weigh on the euro and several Asian importers, while supporting the dollar and contributing to outperformance in energy-heavy indices and sectors. At the same time, there are limits to the damage so far. European equities have stayed relatively resilient as long as Brent trades roughly in an $80 to $100 band. The global economy is less oil-intensive than in past cycles, and alternative supply routes and inventories have helped avoid an outright shortage, even as risk premia in oil, aluminum, and gas remain elevated. Despite higher energy and yields, growth indicators remain surprisingly firm. In the United States, the mix is shifting from purely consumer-driven toward capex-led, with AI and national security-related spending accounting for a large share of recent GDP gains and supporting strong large-cap earnings. Consumer dynamics are also evolving. Lower-income households are now seeing faster wage growth and have driven recent discretionary and restaurant spending, while global travel demand remains robust, with hotel groups reporting mid-single-digit revenue growth, strong U.S. leisure trends, and continued recovery in Europe and parts of the Middle East. Regionally, Europe is benefiting from positive growth surprises and improved earnings, with banks and defense names cited as relative bright spots. While in Asia, markets like Singapore and AI-linked exporters in Korea and Taiwan enjoy earnings upgrades. Offshore capital continues to seek U.S. assets, drawn by innovation and earnings strength, but there are signs of a broader, though still selective, equity advance. The risk is that this acceleration is narrow and policy-sensitive. Growth leans heavily on AI-driven capex, energy-intensive infrastructure, and still confident consumers, so a sustained shock to oil prices, tighter financing for AI, or political backlash against data centers could all test how durable the current expansion really is into 2025. To sum up, AI is entering a capital-intensive phase where financing structures, credit spreads, and regulation matter as much as chips and models, even as productivity gains and earnings growth remain supportive. Energy markets are still trading with a geopolitical risk premium, keeping inflation uncertainty elevated and anchoring long-term yields at higher levels. In global growth, while resilient and increasingly capex-led, is leaning on a relatively narrow set of themes that are sensitive to both funding costs and geopolitics. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.